Good morning, everyone, and thank you for being here today. I'm excited to kick off this presentation on our Nifty 50 intraday options trading plan. Today, we'll explore strategies and insights to help you navigate intraday options trading effectively. Over the next few slides, I'll walk you through our approach, key considerations, and practical tips to enhance your trading performance. Let's get started. Let's take a closer look at the market structure overview. First, we saw a sharp rejection from the 26,300 zone, which indicates that there was significant resistance at that level. This kind of rejection often signals that the market was trying to push higher but faced strong selling pressure. However, there was a strong recovery from the 24,800 demand area, showing that buyers stepped in quickly when prices dipped there, highlighting its importance as a support level. Currently, we're observing a period of consolidation near the 25,900 to 26,000 range. This sideways movement suggests that the market is taking a breather, with buyers and sellers in relative balance for now. Looking at the overall bias, I would say that if prices manage to stay above 26,000, we might see a shift towards a mild bullish outlook. This range-bound behavior is essential to watch, because a sustained move above that level could set the stage for further upward momentum. So, in summary, these key points help us understand where the market has been and where it might be heading, providing valuable clues for our trading decisions. All right, let's take a closer look at the key support levels that we need to watch for. First, between 25,750 and 25,780, we have the immediate intraday support. This is where the price might find some quick footing during the trading day, so it's crucial to monitor this zone closely. Then, moving slightly lower, between 25,580 and 25,600, we see a strong demand zone. This indicates a significant area where buyers are likely to step in, providing a solid foundation for potential upward moves. Finally, at the extreme end, between 24,850 and 24,900, we have the trend support. This is a more critical level, acting as a key support line for the overall trend. If the price approaches this area, it could signal a potential reversal or a strong bounce. Understanding these support levels helps us gauge where the market might find stability and how prices could behave around these zones. They're essential for making informed trading decisions aligned with the overall trend. All right, let's take a closer look at the key resistance levels on this chart. First, we have the zone between 26,000 and 26,050, which we refer to as the psychological and supply zone. This is a critical area because it combines psychological price levels with supply zones where sellers tend to step in more aggressively. It's an area to watch closely for potential reversals or consolidations. Next up is the 26,300 to 26,330 range, which is identified as a major rejection zone. This is where we often see strong selling pressure, leading to sharp reversals or pauses in upward momentum. Recognizing this zone helps us understand where the market has historically hesitated or turned back. Finally, we have the area beyond 26,400, which indicates strong supply. But it's important to note that this is driven primarily by momentum. When prices push past this level, it often signals that buyers are still very active, but the key here is to watch whether the momentum sustains or fades. Bringing it all together, these levels form a framework for understanding where significant resistance lies. They help us anticipate potential reversals or breakouts, which is crucial for planning our trades accordingly within the overall market context. All right, let's talk about the entry points for today's intraday long strategy. The key level to watch is if the market breaks and sustains above 26,000. That's a strong bullish signal. Alternatively, if it bounces from the 25,750 to 25,800 zone, that could also present a good entry opportunity. Moving on to our targets, once we're in, we're aiming for levels around 26,050, then 26,200, and finally 26,300. These are our key milestones to take profits as the market moves in our favor. Of course, risk management is crucial. Our stop loss should be below 25,730. If the market drops below that, it indicates that the bullish move might be weakening, and it's safer to exit the trade. Remember, the overall theme here is to catch the bullish momentum early and ride it up while managing our risk carefully. Keep an eye on these levels and stay disciplined with your stops. Let's take a closer look at the recommended CE options here. For the ATM, the strike is at 26,000 CE. This is generally our preferred choice, especially in the first half of the trading period. It tends to offer a better risk-reward profile early on. On the other hand, the OTM strikes are set at 26,100 CE and 26,200 CE. These options become more attractive only when we see strong momentum developing in the underlying asset. So the key takeaway is to prefer the ATM strike initially, as it aligns with a more conservative, steady approach. But if there's a significant rally or momentum kicks in, shifting to the OTM strikes can give us a better opportunity to capitalize on larger moves. This strategy helps us adapt to market conditions while staying aligned with our overall risk management principles. All right, let's dive into the current entry points for our intraday short strategy. We're looking at a rejection zone near 26,050 to 26,300, which means if the price hits that level and starts to turn down, it could be a good signal to consider shorting. Alternatively, if we see a breakdown below 25,750, that also opens up short opportunities. Our target levels are set at 25,600, then 25,450, and finally 25,000. These are the levels where we might look to take profits or reassess our position. It's important to note that these targets are based on the current market structure and our technical analysis. And of course, to manage risk effectively, we need a stop loss in place. For this setup, I recommend placing the stop above 26,080. That way, if the price moves against us and breaks that level, we can minimize potential losses. In essence, this strategy is about identifying key rejection points and breakdown levels, and using those signals to plan our entries and exits. It's a disciplined approach to capitalize on short-term moves, aligning with our overall trading theme of quick, high-probability setups. Let's take a look at the recommended strike prices for our options. For at-the-money options, or ATM, we're looking at the 25,900 PE and the 26,000 PE. These are the strikes closest to the current market price, so they tend to have the highest liquidity and premium. Moving on to the out-of-the-money options, or OTM, we see the 25,800 PE and the 25,700 PE. These strikes are further away from the current price, which means they generally cost less, but also have a lower probability of ending in the money. It's important to note that we should only consider using OTM options after we've confirmed the market direction and our strategy. Using OTM options prematurely can increase risk if the market doesn't move as expected. Overall, selecting the right strike depends on your risk appetite and market view. The key takeaway here is to use the ATM strikes for more immediate, higher probability trades, and consider OTM options only when your confirmation signals are strong. All right, let's talk through the trading bias based on the levels we've set. When the price is above 26,000, we're generally looking at a bullish bias. That means the trend is upward, and we might consider more optimistic trading strategies. If the price is between 25,750 and 26,000, we're in a range-bound zone, so it's better to be cautious and perhaps wait for clearer signals before taking positions. And if the price drops below 25,750, that suggests a bearish bias, indicating a downward trend where shorting or cautious trading might be more appropriate. Now, apart from these levels, there are some important notes to keep in mind. First, avoid trading in the first 15 minutes of the session. That initial period can be quite volatile, and it's often better to wait for the market to settle. Also, because volatility can pick up unexpectedly, it's wise to trail your stop. This way, you protect your profits if the market moves against you suddenly. Remember, these levels and notes are tools to help you stay aligned with the overall market trend and manage risk effectively. Keeping these principles in mind will help you make more informed decisions and stay disciplined in your trading. This slide is really important because it reminds us that everything we've discussed today is for educational purposes only. It's essential to remember that options trading, while potentially profitable, involves significant risk. So, before you make any trading decisions, I strongly recommend consulting a SEBI-registered financial advisor. They can help you understand your personal risk tolerance and guide you towards suitable strategies. Ultimately, the goal is to equip you with knowledge, but always prioritize professional advice to ensure you're making informed choices.